Good morning, traders, and welcome to the Bookmap Pro Trader webinar series. This is Bruce at Bookmap. Today we have FuturesTrader71, Morad Asghar. You probably know who he is. He's going to talk about trading order flow in the context and getting on the right side of trades by understanding the narrative, and then use order flow in Bookmap to fine-tune entries. So risk disclaimer, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Let me give a brief introduction here of FT71. He's been trading for over 20 years. He started his own prop shop until 2003, and then focused online with online traders. He's a recognized pioneer in the use of volume profiling. He's currently the head trader and director at Conversion Trading, a virtual prop trading environment for career professional traders. He's the founder of EdgeClear, an innovative brokerage designed for online traders. And then FT has been using Bookmap since its initial release more than about 6 years ago or so. So anyway, if you're interested in contacting FT, here is all of his contact information, his websites for both training and for the brokerage, his Twitter, his YouTube, his email. And then if you're interested in some special offerings for Bookmap from FT71, here's the affiliate link here. Don't worry, I'm gonna cut and paste all of these links into the chat for you so you can click on the link directly and go to the websites or whatever it is that you're interested in. Let me turn it right over to FT.
Thank you, Bruce, and hello everyone, wherever you are. I hate to say, I don't want to say good morning because it is here in Chicago, but it may not be where you are. So today we're going to focus on the using order flow in terms of context. Okay, so I've come on, and I'm sure many guests have come on to speak about Bookmap and talk about the nuts and bolts of what they do, how they see things within Bookmap. What I want to do is take a more broad view on things. The market's currently doing what I had expected and talked about in the pre-market video that I release called the Trader Bite, and there's not much here for me to trade off of at the moment. I want to remind everyone that derivatives trading is not suitable for all investors, and past performance is not necessarily indicative of future results. Here's what I'm going to cover today. I'm going to make this as quick as possible. And if you have questions, it is best that you type them in as soon as you think of them. If I'm being unclear or if I've said something that's throwing you off, just ask, and we'll do our best to address it as we move along and keep that kind of a part of the conversation. What I'll cover today is just a brief overview, just a brief talk about what the typical online trader experience is. I'm suspecting that many here are still trying to figure out what they need, what tools they need, and what they need to know in order to trade futures. I'll discuss briefly why I prefer futures over other instruments, what we need to do to maintain a sustainable approach. The market is a story. We'll talk about the narrative of the market, and then talk about what pieces will likely go into the pieces that we need to put together that translate into what I call the tip of the spear, which is Bookmap, right? So let's take, I like analogies even with my prop traders. I used to get made fun of a lot with my crazy analogies, but think of this as it's a new day and we are hunters. This is our profession. We go out and hunt. And Bookmap, and the version that I use called CT Bookmap, you can find it at ctbookmap.pro, including the special offers and whatever else. Again, ctbookmap.pro. The Bookmap is my spear. It is, or if you like to use a bow and arrow, it is my arrow. It is the thing that I need to to pull up and zoom in for the point of execution or the point of releasing the arrow. And so let's put that into context, because it's very easy to go and get a demo or a trial of Bookmap or subscribe to Bookmap, and then all of a sudden there are all these areas that appear to be opportunity areas. And that's okay. There are people who trade like that, where, you know, that's how I started my career as a high volume scalper. I used to do about 3,000 sides a day. On regular days, a lot more on busy days. So I was a very, very busy trader. So I basically was a market maker across several products: DAX, Eurostox, ES, crude, Bund, and I've moved away from that approach quite a bit since 2005. I started using Bookmap when it was pre-released in 2014. I don't recall, but it was around 2014 when it was in development. So I've been using this product for 6 years or so. But the goal here is to really break things down. So let's start with that. The first thing I want to share with you is, one second, is this. Some of you, I don't know how many of you are familiar with let me ask you, who here, just type in your chat box in front of you, who here has never watched a Trader Bite or doesn't have a clue who I am? Just type in me or something like that. You want to do that? Let's make this a little bit more interactive. Okay, it's fair. There's got to be many more of you. So I do this video every day. It's a pre-market video. We're on episode 1843. It gets about 1,200 views on YouTube and about 700 to 800 views on Periscope, which is the Twitter-based live streaming feed. This is a free thing. I've been doing it for so long, and it is something I used to do in my prop shop, where we just, before the market opens, we used to just be in the room, everybody's doing their homework, and they get a little kind of prep sheet, and you know, all the traders get a prep sheet, and then I would talk through the market and how I'm seeing things. Those traders that want to listen. Those who don't, just have their headsets on with their news feed and they're doing their own thing. Today's Trader Bite discussed how yesterday played out as expected, mostly. So what I do during this Trader Bite is I replay the prior day. So let me show you. So I show what happened, what I expected the prior day. The green is the primary scenario, or the most expected play of the day. That's the green part. The pink is the second most expected play of the day. And then, sometimes I have a third play. Let me see if I put one in here. I think I had scenario 3. No, I didn't. I might have a third play, like when we're out of balance or trading outside of the prior day's range. I have a third play, and that's usually more aggressive, because the market's out of balance. The response is likely to be more aggressive. So you can see that for yesterday, this is reviewing yesterday's action. In today's video, I'm reviewing yesterday's action, and I'm saying, hey, do we expected a pullback and then a push? We expected it to go to 33.08 and a quarter and pull back to below 3,300. And then after that, I go into what it actually did, and you can see it opened, it tested higher, just like I expected pre-market. This is reviewing yesterday, this morning. I know that's confusing, but that's what I'm looking at. I'm looking for the market to respond, and I'm looking for it to go to 33.08 and a quarter. See 33.08 and a quarter up here, or half. The market went to 33.0950, and then it dropped below 3,300 to close. So I'm simply holding myself accountable and saying, look, when Tuesday morning started at about 8 a.m. Chicago time, 9 a.m. Eastern, which is when this video takes place, this live stream takes place, here's what I expected. And then I came back this morning. You can see the date's the 23rd, which is this morning. I came back this morning and said, okay, here's what I expected, here's what it did, and I go over what it did, why it worked and why it didn't work, and so on and so forth. Why am I telling you this? I'm telling you this to say that you need to understand the overall picture. So let's take a step back for a moment and go back to my slide here, which isn't coming up. Oh, yeah, there it is. Let's go back for a second to my slide. What is the typical online trader's experience? The typical online trader's experience has nothing to do with what I just showed, which is what I've been doing as a professional trader for ages. Since I stopped scalping in volume, I started to do this routine every morning. It's almost like a religious thing that I do on a day-to-day basis. And what the online trader does is they come in and they get their platform, whatever it is, whatever, Rhythmic or Thinkorswim or TradeStation or whatever you have, and they just see a lot of stuff. They see these charts, they see these numbers, they may have copied someone else's stuff, and it's just like all these blinking lights and everything else. Or they jump into Bookmap and they see these dark and light lines and they see all these fancy things everywhere. This is my Bookmap screen. I actually usually view it in color, but we'll do monochrome for today. It just simplifies things for me. At least I don't have to mess with the colors. And it's so easy to say, okay, I don't know what I'm doing and I need to do something, because you know what? I'm useless if I'm sitting here doing nothing. So look, there's a line at 32.98 1/4. So I'm just gonna sell that. I'm just gonna offer that out. Okay, I just offered one lot in the micros or whatever. And it just becomes more of a gambling experience. And when it works, what we do is we reaffirm to ourselves that this is actually working, that I've got this. And when it doesn't work, it knocks us into this, should I be trading? Is this gambling? Is this? And we end up in this very volatile process, which ultimately grinds us down to the point where we just start throwing risk out and start taking excessive, we start to trade excessively, taking excessive risk and so on, because you know what? I don't know what I'm doing anyway. I might as well enjoy the process, which is a very poor way to approach trading. Everybody's happy to take your money if that's the attitude that we're going to have about trading. So my goal here today is to talk about how do we, instead of pulling up Bookmap and talking about what it does and how I use it, which I've done in the past. There are many, many videos on Bookmap's site and YouTube channel that I'm on where I go through like some technical detail. I felt that it's really important, since we're coming into the more active part of the year, coming into this October period before we go into the lull, the holiday lull. I just want to make sure you understand what's expected of you, because most people just don't give themselves the time or have the chance to really see what's going on. So the first thing a typical online trader's experience is to get a tool and just want to click. I've got money in an account. I know what my margin is. I know what my commissions are. I'm just going to click and I'm going to test my luck. And this is not, and the reason I have this experience is because since about 2008, while I was running my prop shop, I was also spending a lot of time online and became engaged with the Twitter community, and started to get a following, because I was basically breaking things down to what you really need, which is the conversation we're having currently. What do you really need in order to extract money out of the market? Again, past performance is not necessarily indicative, and you have to do your own homework and figure out your own approach. And that's the thing, you cannot copy someone else. There is no way to copy someone else. So just because I've watched somebody who's been hunting for a long time follow this particular path to this particular creek and then sit there for an undisclosed amount of time, and then finally they disappear, and then they come back with whatever prey they're hunting, doesn't mean that if I followed the exact footsteps, went to the same creek, sat there for 2 hours like they did, that I would do the same thing. I actually have to understand the what's in that area. Is this the right place to hunt for the things that I'm looking for? Is there enough of a population here? Is there an edge to hunting in this particular area of the forest versus another? What is the habit of the prey that I'm after? What point does it go and look for water to hydrate itself so that I can hunt it? Things like that. And really, most people try to mimic someone. Don't try to mimic someone. Don't try to mimic me. What you have to do is get an understanding of what's going on, and then because of your understanding, now you come up with your own unique approach. If your approach is not unique, it is likely to not have an edge. And if it does have an edge, that edge is not robust, and it's likely to be blunted very quickly. So like a moving average crossover might work in a certain environment, but you'll get chopped to pieces and you'll run your account down to zero in other conditions. And unless you understand the market that you're trading, throwing two moving averages and trading the slope of those averages or crossover isn't going to get you anywhere. So first things first, so that's the online experience. You go away, you think you kind of figured it out, but you've run out of money, you go to work or put another stake together, come back, subscribe to a bunch of software, which is needed. Those are the tools that we need to hunt with. And then repeat the process, except get just a tiny bit closer, but for a huge expense and a lot of time. What I'd like you to do is consider a different approach. Consider that the market is one big, long, continuous story, okay? The market just constantly kind of evolves. This chart here is simply this is the ES. It is what I call the composite chart. Each bar is the pit session bar for the day. And it's, we can see how it's moving up and down and up and down, up and down, up and down. We can see how the pandemic low, took us from all-time highs in February, brought us to lows in March, and then we've rallied like crazy since then to new all-time highs. And as soon as we made all-time highs, we've rolled over, and here we are in a corrective phase of the market. And everybody has access to this chart. You go to a daily chart on pretty much any platform, and you will get this sort of thing, okay? I don't need to explain what the little pieces are, bits and pieces of the chart are, but this is generally what everybody looks at in terms of what the narrative is. And this is where we start. We start with a bigger time frame, except that I apply volume profiling to what I see. And the reason I apply volume profiling is because one price is not the same as another price. And the thing that makes one price different from another price is how much participation took place in between among those prices. For example, if we look at what has happened over the last couple of days, let's zoom in. You'll find that the market tends to move from high volume node to low volume node to high volume node to low volume node. So how am I supposed to do this? How is it that I do this trader bite every day and I talk about what are likely targets? It doesn't always get to what I expect. It doesn't actually do what I expect all the time, but it gets pretty close. And if it doesn't, that's information that I can use as well. So you can see as we dropped from the all-time high, we paused at this 3360 area. This 3360 is the most traded price from the gap up on August 3rd to the all-time high. It is the most traded price. We came back to it, we chopped around it, and then we broke lower and we moved to the next balance area's most traded price. That price is 32.1675. Recall the low of 2 days ago was 32.1775. A new person might look at that and say, but you said the number is 32.1675. It stopped at 32.1775. Why does that make you correct? The thing to note here is we're not sitting here looking for perfection. Trading is messy. Remember that. Trading is messy. We're operating in zones and ranges. The S&P currently has about a 3.5 point harmonic rotation, or the ebb and flow in a 1 minute period of the S&P is about 3.5 points. Okay, so that's, what is that? 14 ticks, 14 ticks. And we missed the balance low by 4 ticks. That's pretty much spot on for this product. So we want to understand what it has done in the big picture. We tested one big, let me pull up the pens here because you're probably wondering, what is this guy going on about? So we've tested one big area. We've tested this high volume node right here, this black line, and it's made up of everything, all the volume accumulated from June till August because we were in balance in that phase. Then we gapped up, we broke that balance, and we ran up to new all-time highs and formed a new high volume node right up here, okay? And what we did is we failed from the high, came back, we chopped around the high volume node, this area, we chopped around it, which is completely expected because if we like that price, then we're gonna trade a lot at that price. If we trade a lot at that price, we create a high volume node or an area with a lot of volume. And all I'm doing here is showing accumulating volume at price. And so if we like that price, then a lot of chop and a lot of churning is gonna happen. If we fail to hold that price and we break away, we're likely to move to the next most accepted price down below. Once we test that next most accepted price, and if we don't just slosh around and fall through, then we are likely to move up and we are likely to rotate back to 33.60.50 in the December contract. That's what this price is. Okay, and I have these prices memorized because I understand the story so well, almost like if you're watching Harry Potter and you've read every single book, you can kind of see where the story may go, right? You can kind of, within a reason, predict what is likely to happen next. Harry Potter lost this thing and therefore he needs to recover it. In order to recover it, he's got to go through these tunnels with the spiders and do this and that. I'm not a Harry Potter fan, but my kids are. And so I can, within reason, predict what is likely to happen next. And what the market generally does is it moves from high volume node to low volume node to high volume node to low volume node to high volume node to low volume node, and so on. And it does this and it goes back and forth, and its goal is to seek balance. It's to seek balance. It's trying to find, the market's job is not to take your money, is not to run your stops. Those are just little gimmicks within the market action. What the market's trying to do is it's trying to find balance. I'm going to translate that into Bookmap at the end. I know you're thinking, hey, I'm at a Bookmap webinar here. Why are you talking about volume profiling and showing us this chart? Show us Bookmap. But I'm going to translate this to Bookmap in a way that will help you become more effective using the tool and also help you to not overtrade by using Bookmap as a tool. And so with that, I expect and I anticipated after Monday was done, yesterday was supposed to be a test of Monday and a push higher above 3,300, and the prediction was 33.08. It went to 33.09, 33.08 quarter, went to 33.09 half. And you can verify that. This is not hindsight 2020 because you can verify that by watching yesterday's YouTube video that was done before the market opened at 9 a.m. Eastern. and verify what it did against what the market said. And so this morning, so the activity that's supposed to take place is it's likely to balance here, and it's likely to rotate up to the 3340s, and then ultimately come back to 3360 if it continues to drive. So that's what we call the narrative. That is the story, okay? Why it happens, is it because SoftBank was involved with this gamma trade and options that forced market makers to cover their calls by buying stock and causing this massive and ridiculous rally in the NASDAQ? And it doesn't matter. I don't care why. My job is not to know why. Now, if I was working at CNBC and I was a broadcaster, if I wrote a newsletter or something, an analysis, I would be concerned with the why, but I don't really care about the why. What I care about is what price is trading and how much is trading at that price. That's it, because the market is going, although not perfect, it's not a perfectly informed and a perfectly efficient market. It gets pretty close. It automatically reflects all of the thoughts that go into what's happening into price, and volume tells me how much I like it or how much I don't like it, or how much I agree with it versus how much I don't agree with it. That's where volume profiling comes into play. And for those of you who are confused, I cover this stuff all the time at Convergent, and I've been talking, there are hundreds of YouTube webinars and so on that you can watch online for free. But this becomes my understanding of the auction. So, most of you are renting an apartment or buying and selling a house, or have owned a house and have sold a house. Think of it that way. When you speak to your realtor is going to talk, they're not going to talk about the technical features of the house that you're selling versus the technical features of the houses next to it, to give you comparables. Your realtor is going to advise you on whether or not it's a good time to sell your house by looking at the overall inventory of the market, the prices that are being accepted. Is the median home price in your area rising? Is it falling? What are interest rates doing? How easy is it to get a mortgage? The cost of money, all these things come into play, and then your realtor will look at your home, will do a walkthrough, and will say, you know what, we need to repaint this wall. We need to do this. We need to get all of your old, cruddy, gross furniture out of here and rent some furniture to show the house so we can get the best price. That's the execution phase. So the realtor is looking at the big picture. They're looking at the narrative. What is the story of what the market has gone through, and where are we today? So let's narrow that down. So once we look at the overall picture, we look at what has happened the prior day. So that's where this comes in. 1 second. Let me find, okay, here we go. So once we look at what it did yesterday, and then we look at, so this is what it did yesterday. So I'm reviewing what it did yesterday. Now I'm looking at what it's done this morning. So this here is yesterday, Tuesday. This is what has happened in the extended trading hours. We see that the market took out the high of yesterday, put in an overnight high at 1975, which corresponds with the key 1775 area. That's what this stock zone is. That's what this stock zone is right here. These gray lines are called stock zones. They're lines I put up and update at least once a day. These are the areas that I expect the market to react at. So you can see the market topped out. You can see the market topped out at yesterday's 33.08 quarter stock zone. And then when it pushed through the overnight high, yesterday's high, it topped out at the 1725 stock zone. So I understand that my zones are still strong and they're still quite effective. So I need to lean on that. And then I come in and I look at it and I say, I see that the market has attempted to push higher, but really it is coming back to the point of control of the overnight session. It's holding steady, okay? And then based on that information, we move forward. I look at Bookmap, I look at CT Bookmap, and look at the features of the order flow. So I'm describing this. I show Bookmap almost every day in this video because I'm narrowing down the idea or the story to what has executed in the overnight session. And then I move forward to the narrative of today. So I've used up a good half hour to get you to this point. These are today's scenarios. You can go and view these. Just go to youtube.com, look up, search FuturesTrader71, and you will see that these are the scenarios for today. The initial scenario is to push higher and to sell off. We are currently selling off, right? The secondary scenario is to sell off immediately, but then we'd get an impulse up and it will start to migrate towards this 3340 area if it cannot hold the 1775 from this morning. The third scenario is it attempts to push higher, fails, and then does an open test drive, and the drive is likely to take us to 83.75. This is where we are now. We've kind of driven this morning 83.75, expecting the market to chop around in here, and then expecting it to fall to 70.50, which was a key figure from yesterday and the night before. So 70.50 becomes scenario 3's key test price. Okay, great. Now, so that's coming into the session. Those are the ideas for the day. Then the market opens and we look at what did it give us. Okay, what it gave us, let's switch this to a 4 Renko, which is what I normally use. What it gave us is it opened at the extreme of the prior day. So this is the profile of the prior day. This chart does not include overnight. It only shows what's happened during the day session. So the blue profile is always the day session. Orange is the entire session. Yesterday, we opened right at 3309 and a quarter this morning, which was yesterday's high. We opened right dead nuts on yesterday's high. We tested down to 04.5. We went to 11 quarter, held sideways. So it's an open auction. It's a two-way auction. It's chop, and it attempted to break out. So this would have been scenario 2. It attempted to break out. And what I'm looking for now is it starts to break out. Then I'm looking for, on the heat map, I'm looking for a bid to show up below it at about 3310 to 3309.50 for it to pull back to that area and then start to push 1250. And that's what we call initiative buying, meaning the market is not liking yesterday's prices and yesterday's area that it accepted or traded at, and it's starting to move away from that price, which is not our expectation. Our expectation today, again, was that we would likely move back into yesterday's range. Remember, that's what was predicted in this morning's trader bite. Test higher, then fall back into the prior day's range, the blue. So we're looking to fall back into the prior day's range. And that's, so scenario 1 and 3 look for reversion or pull back into the prior day's range. And scenario 1 says it's not likely to be very aggressive. When it does, scenario 3 says it's probably going to be aggressive and it's likely to be a trending kind of move down, right? Scenario 2 is the one that tests down and then starts to break higher and run away. So here's what has happened so far. We have tested up. We're solidly back into the prior day's range. So what is the primary target as we push into the prior day's range? So now, seeing as it's moved into the prior day's range and is not pushing back out. In other words, it's not turning up, getting above VWAP, the day session VWAP, and back out of yesterday's range. Now I'm removing from the table any buying. So pay attention here, because people tend to want to trade from both sides, no matter what the narrative, no matter what's going on. They want to trade from both sides. And so I, I, I don't want to do that. I don't want to do that. I want to trade in the direction that the narrative tells me the market's willing to go. Or I want to trade in the direction that facilitates the easiest returns for my risk. There's always risk. A trade, any trade at any random time may not work. I know that. It's okay. It's okay. I accept this as a trader as it's the reality of the market, that the outcome, the next time I click and get into a trade, the outcome's completely random for that particular trade, period. But what I want is what I want to go for as a professional, as someone who wants to trade sustainably, and I'm supporting this by getting the best data feed, getting the best analytics package, getting the best order flow package, which I believe is Bookmap, right? And I'm supporting I'm giving myself the best chance. And so the best chance for me is to just look for shorts. So that eliminates the anxiety of missing the bottom. That eliminates the possibility that I might be trying to catch the bottom and losing my ass doing that, which is a very common thing for new traders to do. So now we're moving into the area of what we need to maintain a sustainable approach. What you need to maintain a sustainable approach is an understanding that the market is an auction, and an understanding for your particular product, whether it's crude, NQ, Bund, Bobble, Shots, Euro stocks, CAC 40, whatever it is. I don't care, NASDAQ, YM, RTY, you name it. Whatever that product is, understand the narrative. So if you've been away on a week for vacation, go back a month, or at least 2 weeks, right? Go back the week that you missed and the week before, and play back the market on your bigger time frame chart. I like to use 15 minutes for that, or some sort of a point and figure chart, and play it bar by bar and look at what it did. Okay, what did it form? What areas did it accept price in? The way I can learn how it accepted prices or rejected prices is the volume profile. Acceptance means a lot of volume occurred at that price. Rejection shows that very little volume occurred at that price. And I walked that chart forward, bar by bar by bar by bar, until the present. And the goal here is to understand the narrative. The market story is what I'm after, because as a trader, I'm trading the story, not the indicator, not the collision, not what Joe Schmo said. I'm trading the story. The big traders in the world who are not fully automated or algorithmic are coming in, and their biggest edge is their understanding of their market, right? Like Bruce Lee said, I don't fear the man who has done a kick, has done 10,000 styles of kick once, practice a kick, 10,000 kicks one time. I don't fear that man. This is Bruce Lee. He says, I fear the man who has practiced one kick 10,000 times. And that's what we want to be. We want to understand our market better than any other participant we can possibly lose money to. So I don't need to be the best, but I can't be the last. I can't be the person that comes in and wakes up, shows up, and then just trades from the gut. I don't want to be that. I want to be the person who really understands this market. I know that if I don't make money today, it is okay. It doesn't tell me, I don't have to quit. I'm not a terrible trader. It just means that I didn't have alignment. I followed my plan and it just didn't pay off. And that's normal. I know that tomorrow I'll probably come in and do something with it, or the day after that. And the reason I know that is because I understand my market better than most other people, or many other people. Think of the joke. The way to not get eaten by a bear is not to be the fastest runner. It's to be faster than the slowest runner. I'm sure you've heard that, right? So our goal is not to be the greatest trader. Let's just be modest and realistic here, because to be the greatest trader requires a level of commitment that most people cannot pull off. Our goal is to be better than others. And most people in the online world don't do the work, don't understand the market, aren't figuring out the alignment they have with the market. And so now we want to break down the pieces. So once we have determined what we're likely to trade, what we want to trade, it boils down to where I engage. And I'm using Bookmap to engage, right? So I'm trading right off of Bookmap. I'm using the rhythmic feed. I believe it to be the best feed out there. And I'm a professional. I've used TTX I've used CTS, I've used, for a period, I even used TradeStation, and that was really terrible for direct market access on futures. I use Rhythmic. It gives me the full depth. I can see where something is bid or offered as far as the eye can see. I can zoom out and I have a live depth, full market depth. I have MBO data, which means that I have all the details that the professional shops get. I can see that there's a nice offer here at 32.98 and a quarter that's been sitting here a long time. I cannot recall that. It's not possible for me to recall that level of information by looking at, the tape and the classic 10 offer, 10 bid dome. I can just look at the heat map and see that this person has been here a while. This order's been here a while. And as long as it doesn't go from white to grayish, to gray, to dark, to black, as the price moves up to it, and if I believe that I have a reason to sell in this area, then I know I can lean on that price. So this is where Bookmap shines. And so once I know that I'm looking for shorts, what's the next thing I need to do? I need to determine what areas are going to give me an edge for my execution, and I need to monitor how the market's rotating versus the size of my stop, right? So harmonic rotations again. If for example I sell short and I only provide 3 ticks for a stop, when the market is sloshing around in 6-point ranges because it's extra volatile, I'm donating those 3 or 4 ticks from my stop with slippage. I'm donating that money. I might as well just pull that money out of my account and send it to my favorite charity, because that's what's going to happen. So I need to be aware of how's the market flowing, right? How is it flowing? It's got pretty wide ranges. It's hitting about 5 points at the moment, and I need to assess whether or not that's too much for my account size, because I don't want to risk too much on a single trade. But I also know that I'm going to lean short today. So you can see we opened way up here, pretty crowded. We finally break through. Areas of interest currently are right here. This, in fact, I missed it. Let me just do this again. See the zipper here, which coincides with this offer. The top of the zipper is right there. So for that trade, I need about 5 points of range, 5-point stop. I have liquidity right here to lean against. You can see that liquidity in the dome right here. Okay. The next areas that I want to be interested in is, are we going to remain stuck right here? It's really hard for me to draw with a mouse. So this is another area where the market battled. You can see those red and blue dots. And by the way, my dots are filtered. I filter everything. I don't want to see a lot of noise. So I'm filtering my dots by 50. I turn off the smart clustering. I just want to see the dots for where they are. But I filter by 50 lots, and it tells me that there's a fight here. So there's a fight right here. I need to pay attention to this area. I've got a bottom. So this area resulted in a collision, a pop to the next. This is the next zipper right here. This is the next zipper above. The market has tested the extreme of that collision. Let me choose another color. Let me just do a nice loud color for you. Pink. So let's clear this out. Let me ask you, I've been talking a lot. Are you following? Are you following along as to what I'm talking about here? Do you understand the point that I'm making? Everybody, that you've got your keyboard in front of you, just go in the chat box and say yes or no, right? This is what it takes. This is what it takes. Unless you are algorithmic and you're automated, this is what it takes. It is not a matter of finding some liquidity level and selling in front of it or buying in front of it. It's not a matter of getting that super duper add-on plugin by this guy to, it's not. That all supports, that stuff that supports your execution or decision-making process. But trading is what I'm talking about. So you want to watch this video again, because I'm telling you what level of thinking and commitment you need. I'm just being very honest with you about what it's about. Okay, and you'll notice that my chart here is very simple. I have a session-long volume profile, very important to me because I'm a volume profile person. I have a chart-based volume profile because sometimes I want to see the top and bottom of a zipper and how much went on. I'll show you how I use that in a minute. Maybe Bruce, you can remind me if I didn't cover it. This here is a Cloud Notes column. These levels are uploaded to a convergent server, and these are key areas. The stock zones are key areas I want to interact with the market on. So if I have liquidity within a stock zone, I'm going to engage. If I don't, then I need to lean on something else. But stock zones are very important. These are areas that I expect the market to react at. So you can see the stock zone here. If I extend this stock zone out this way, you can see that it received a lot of engagement in here, up here, right? These are areas I'm expecting the market to engage at, and these pre-exist the open of the market. I'm not aware of where the market's going to respond, and I'm also, I cover how you create these stock zones and how you generate them and stuff within Convergent for the members. And the goal here is to have you map out what you're going to do for the day. That's the narrative, and then come in and execute. So let's get back to execution. Key area right here. See how it was just tested again, tested from above. A fight happened right there. Broke higher, failed, tested from above, lower high. If I was looking to get short and I missed this, this would be the area I'd be looking to get short, right in here. Lower high from the last high, and lower high from the most recent high. Look to hit the bid, look to push, look to exit before the next key consolidation area, not exit, but scale. You can see there's a lot of dots there, pulls back a little bit, breaks through, then it tests this key area, which again, tested here, tested here from above. This is the next key area to lean on. So we have a new zipper. This becomes, now the chart shifted, of course, and I got to redraw these things. Now, if I'm short, I'm monitoring this area. I'm going to stay short as long as it doesn't take out this region right here. I'm going to stay short. And my target for the short could be, the extended target for the short is 70.50. 70.50. It's 9 points away. And as long as the market does not breach the last big zipper that I'm looking at, I'm not interested in getting out. So if it comes back, consolidates, forms a zipper, then that becomes the next area I manage risk with, because the market has to work really hard to break through these zipper areas. And if it does break through the zipper area, it tells me that, okay, my idea is probably done. Okay, so oftentimes I'll scroll out and I'll see what is next in terms of firm liquidity. Remember, what was the level I just mentioned? Does anybody remember? What was the level I just mentioned? Wow, some of you are listening. Good job. So 70.50, so I mentioned that before I scrolled out. What do we have here? Liquidity at 70.50, long-lasting liquidity at 70.50. So This gives me confidence in my short that I need to hang in there. Market generally moves towards liquidity. I can explain the reasons why, but we don't have time for that. So I see that 70.50, this confirms to me that this stock zone here is meaningful. The 70.50 now becomes two things. One, it is an area I really need to either get out in front of or scale in front of, or it's an area on a first test. In other words, it tests, pulls up, puts in a higher low, starts to rotate up. It's an area that I might be able to get long for a scalp long late in the day, scalp long, because structured trades are only short. Do you guys remember why I'm saying structured trades are only short? Do you remember that? You remember why I'm saying structured trades are only short? I know a lot of you are probably really lost. It's like drinking out of a fire hose when I go over this stuff. But remember that based on the narrative that the market created early on, the big picture, the plan is that we're only looking short. We're back in the prior day's range. Do not forget this. Do not get caught up in the tick action and forget what the big picture is. Stick with the big picture. Keep the big picture in mind. So structured trades, these are trades that I'm looking for sizable returns, meaning 5 to 1, 8 to 1, 10 to 1 risk reward, or 10R, 5R, 8R. Structured trades are the real trades, and then scalps are just little anomalies where I'm just trading the flow. I'm trading against the structure. So buying today is scalps. These are going to have smaller size, smaller risk, smaller reward, and they are just participating in the order flow opportunities as they show up. But structured trades are short based on the big picture narrative. They're in order to sustain yourself as a career trader, which is really the goal behind Convergent. It's why we created Convergent, right? Opening up how you trade as a professional to any trader that wants to have it. The goal is to have a robust plan or a robust approach to the market. And in order to have a robust approach to the market, you need to understand your market. That's your edge. That's your edge. And then what you need to do is use whatever tools you feel help you find your spot within that edge. Okay. My edge has been the same for 15 years. I started moving from scalping super high volume, basically market making, to looking at MACDs, CCIs, RSIs, all this stuff, because I needed to move out of the scalping realm because HFT had taken over scalping. The CME changed the rules so that it wasn't reporting the quantities on the tape, the fills on the tape the same way. It was breaking them up, which Rhythmic allows you, and Bookmap reconsolidates those, by the way. Really important. So I needed to move out of the tick scalping realm and move higher. So I looked at everything, fibs, again, all this stuff, right? Wyckoff. It's just I was running a prop shop, and the future of this prop shop was in peril. I needed to find something better. So I moved to market profile, which immediately made sense to me, the auction. And then after a while, market profile, because it was built on time, 30-minute brackets of time, it didn't make sense to me because I was using XTrader and I had this tick volume and it was accurate, and XTrader was forming a profile to me. So I started to look at volume profiling when nobody else was talking about it. And so I looked at volume profiling and I looked at how it responded. The market responds at high volume nodes versus low volume nodes. Okay, and then I started to distill that into a plan, and that hasn't changed since 2005. I don't need to change what I'm looking at all the time. I might change the tools, but the overall market view remains the same and has remained the same. Okay, so what are we looking at right now? Actually, I think I'm over my time. So we broke down the pieces and we translated it to the tip of the spear. the hunter's spear. We engage with the market. How? If, of course, this sell-off is now extended, right? But if I wanted to engage with it, I know that I can potentially lean at 87 with a 90 stop. If that doesn't work, I can lean on 92 with a 95 stop. And if I'm still convinced that the short, which at that point I'll probably start re-looking at this and considering that the short's probably not the best thing, the next big area I'd look at, you can see it on the profile over here on the left. The next big area that the market's likely to battle in, this big zipper which formed this high volume node, is likely to be in the 94, 95 area with a stop above 3,300. If it breaks 3,300, guess what? Well, let me ask you, since you've been listening so intently and paying attention, here's your pop quiz before we take questions. If it fails above 3,300, if it fails above 3,300, right? Market comes in, fails above, retests, and holds. Where's the next most likely place it'll test? According to what you've learned, the crash course you got today in volume profiling, where was it likely to go? Right on. See, you've been listening. If it fails to get to hold this area and it breaks higher, right? What is the next logical price that it's going to test? Most of you got it. The next most logical price is the high volume node because it's moving from low volume node to high volume node to low volume node to high volume node. So the next big area, so if I get stopped out at 3,300 or above and I see an opportunity to get long, I'm going to hold for 3309, 3310. That is the area that was accepted before. Okay. Inversely, if I am looking for whatever reason to get short up here, you know, in this area right here, 3307, then my stop has to be above 3312. Not because that's the high from this morning, but it's because it's a high volume area. It's the next the top of the high volume area above, right? So that has to be I can't put my stop in here because this is acceptance. It's likely to come up here and chop around. But if it breaks above the high volume node, then I know I'm wrong, because if it was really going to hold this area, it should not be able to get through all of this volume, okay? So anyway, I apologize, I ran a little long. Are there any questions, Bruce, that I need to address before we skip out of here?
I think there's tons of questions in here. I've been answering most of them and trying to answer them for you, but a few questions on the stop iceberg tracker. If you're looking at the market by order data and if there's any sort of confluences that you're getting from that.
I'll be honest with you. I don't use it. You could see it's turned off. I don't really use it. And here's why I don't want to talk about it. I have not put in the work, and it's hours and hours and hours of work. I have not put in the work to understand how I can use that as an edge. And so my preference, as it always has been, is to not talk about, not show something I don't use, because then I just become a salesman as opposed to a trader, right? So that's why it's turned off. I normally have it turned on. I normally look at it, but I'm not putting in the effort. I'm a statistical study kind of person. I'm not putting in the effort to extract the data and, you know, replay it and see how it's responding. So I really cannot address anything to do with the stop and iceberg indicator at this point. Maybe at some point in the future I can come in and talk about it once I feel like I'm proficient at it, but at the moment I can't address those.
Okay, let's see here. Let's see, Ian is asking about, please talk about what structures you use to hide your stops behind.
So stops can take one of two tacts. Not sure if you've heard the term zipper before, but the market goes from imbalance, where it's actively seeking price. That's what trends are, okay, to balance. So balance looks like this. Here's balance, here's balance, here's balance, here's balance, here's balance, here's imbalance, to balance, to imbalance, okay? When it goes into balance, it forms what I call a zipper, a silly term that I invented, but on a candlestick chart, it looks a lot like this, kind of like your pants zipper, right? And there are many things that people call these. They may call it a bear flag and whatnot, and then the market will zipper up and continue, or will zipper up and reverse. I look for zippers to support my trades because if there's a consolidation where the market showed acceptance, like right here, we can see that there's quite a bit of volume that occurred here. See it on the CVP, okay? And I'm short. Let's say I'm short right here, hypothetical, because I think there's a continuation to 70. If I'm short right here and the market manages to walk up to this zipper, trade this volume, and then somehow push through, I am wrong, because if this balance has any meaning, or the zipper has any meaning, or the market lacks strength, which is what I'm expecting, it has to lack strength for my sell-off, my short side to work, then it should not be able to break through all this volume and go to the other side. If I don't have a zipper, for example, I got short somewhere and there's no zipper, then I use a fixed stop. And the fixed stop is based on, again, the harmonic rotation of the product. How wide is the product trading? And harmonic rotations are a statistical thing that I look at, and I have a chart that actually gives me that information. I can pull up any product and on any time frame and look at its harmonics, like here. This is the ES using 10 sessions, 10 trading sessions, so a shorter time frame, less than a month, usually a month. In whatever time frame, I can switch the time frame to, oh, no, I want 10 sessions, and I can switch the time frame to 1 minute. If I'm using 1 minute charts, recalculate, and what it does is it finds a swing high, swing low, swing high, swing low, swing high, swing low, gives me the magnitude of those highs and lows, and it gives me a profile, a statistical profile, and I know for the S&P, the most common rotation right now, based on 10 sessions, 1 minute bars for the high and low, that the harmonic rotation, or the ebb and flow of the S&P in the day session, remember 8:30 to 3:15 Chicago time, I'm in Chicago, is 4.75 points. What does that mean? It means that if I'm using a stop that is inside of 4.75 points, I am well within reach of the S&P just doing its ebb and flow, ebb and flow, ebb and flow. That's a harmonic. I need to be outside. So if I don't have an area to lean against, let's say I got short right here, say at 32.78, then a minimum stop I have to use is 5 points, because I don't have a structure to lean against. But if I'm short against something and there's a zipper there, and the zipper has, is within that 5-point range or less, hopefully less, like 2 points, then I will use the zipper, the lesser of the two. I'll use that zipper because I expect that the market's not likely to break to the other side of it. So harmonic rotations are very important, because they this is in real time. This is real time information. I'm not using an ATR, which is an average true range. And the ATR looks back a certain number of periods and takes an average, but the market is not a normally distributed entity. In fact, everything in life is not normally distributed. So an average generally does not describe what's going on. The average asset value of in the United States of an American citizen, you know, if everybody makes 100 grand, if a million people have an average salary of 100 grand, and then you put Bill Gates and Buffett and Musk and whatever, the Amazon guy, Bezos in there, all of a sudden the average American makes, you know, $380 million. No, they don't. They still make 100 grand. It's just the data is not normally distributed. It's fat to the left. It's got a fat tail in it. And that fat tail is going to pull the average towards the middle where nobody exists. There's a huge gap between the average American and the billionaires that represent, you know, the tech sector. So I don't like using averages. I like to use whatever the market is yielding in real time. And I'm looking back 10 sessions because I got to look back at something. I got to look back at history, and I plot it in a profile, and then the profile tells me that, you know, the most common rotation is 4.75, but 70% of the time, or 1 sigma of this kind of look back period, can be up to 9 points. So it's not that hard, or what we consider normal, which is 1 sigma or 68% of the data set, can be up to 9 points. So technically, I should be using a 9.5, 10-point stop, technically. But I'm only interested in what's most common because that's what's reasonable. I can't use a 9 or 10-point stop on a 1 minute time frame. It's too wide. I'd have to cut my size. Wait, I may have to trade a 1 lot ES to be able to sustain that and maintain a reasonable risk versus the value of my account to reduce my risk of ruin. Anyway, I think I'm mixing a lot of different lessons or a lot of different lectures or webinars into one here because of the questions, but you understand my point here. A stop placement is dependent on a lot of things. Your account size, the nature of the product, you know, the tick value of the product, the harmonic rotations of the product that you're trading in the time frame that you're trading it. So for example, if I use a 15-minute chart, if I switch this to a 15-minute chart, okay, I switch it to a 15-minute chart and recalculate the harmonics, well, the trade count will be 20, and that's too low. That's not statistically significant. So I'd have to go back a year. So if I look at RTH 15-minute bar chart, going back a year, I should not be trading with less than a 13-point stop, because in a 15-minute bar, the rotations are much bigger. Much bigger. And it has nothing to do with the product's volatility. It has to do with the fact that you're looking at a much higher time frame. So all of a sudden it went from 4.75 or 4.5, whatever it was, to 12.75. So if I'm trading a swing or a bigger time frame, I got to have a bigger stop. I've got to have a bigger account, because every time I get stopped, it shouldn't represent more than 1% of my account value. I cannot risk more than 1% of my account value per trade. Otherwise, my risk of ruin increases dramatically. I won't be able to have that many trades before I have to stop trading because I've run out of money. All that, that's all stuff that I cover a lot at Convergent and many other videos, and I can't get into here. And I think we're way over our time, right, Bruce?
Yes, there's just a few more questions if you don't mind, if you have a few more minutes. Well, one question was getting back to, you wanted me to remind you, as well as someone else asked about it, the chart range volume profile in Bookmap, and how are you using that?
Chart range.
The CVP column.
Oh, yeah. Okay, good. Thank you for that. Let's say I'm examining a zipper. Let's say I'm looking to figure out where in the zipper I need to put my stop. What I do is I expand that zipper. Where are we? I'm looking for this zipper, right? I expand that zipper, and I'm using the CVP to see exactly what kind of volume I'm dealing with here. This is why I use it. It gives me a very clear view. For example, I want to know what the bottom looks like. Let's go take a look at what the bottom looks like. Here's the bottom. Using the CVP, I know that this zipper down here at the low has this kind of a distribution. So much of the volume is 74 and a quarter. So if I'm really pinpointing a stop, I would put it beyond that 74 and a quarter on the long, right? I'd hate for the market to get through 75 here, the top of the zipper, but really my stop can't be at the top of the zipper, and I'd rather not have it be the new low. I know that if it gets through the point of control, which is the highest, the point at which there's the highest volume, that's the point of control, also in statistics called the mode. I know that if it gets through the mode here at 74 and a quarter and starts trading 74, I know that it's very, very likely to get down to 72, 75. So the CVP to me is more of a refinement tool, right? So, it just tells me what's happening within a range. So if I look at the last 60 minutes, basically I'm looking at a 60-minute profile when I set it to 60 minutes. Or if I want to know what the profile looks like for the last 15 minutes, I have a 15-minute profile. The SVP is giving me that same information for the entire session from 5 o'clock Chicago time when the market reopened till now. And that's important, but it's just that the CVP really just gives me a way to refine, like what's going on in here. Okay, I see that there's some volume here that went off at 80 and a quarter and 81 and a quarter. And that's what it traded in real time. And with Rhythmic as a data feed, the data is just incredibly accurate. As I check it against my IQ feed and other feeds that I have, it's incredibly accurate. So I can lean, the tick data, I can lean on these volumes that we see here. That's how I'm using the CVP.
Okay. Let's see, there's some other questions. I tried to answer most of the questions in there for you. And I think we're kind of at the end of the session here. If you want to reach out directly to FT, the contact information is in the chat there. I put it in several times for you guys. It's info@convergenttrading.com. You've got all the website information, the special offers from Bookmap, his websites, etc. It's all in there. Anything that you got kind of parting words you want to leave for everybody, FT?
I would say that I've had so much experience. I straddle the two worlds. I straddle the world of prop trading and like doing this professionally right here in Chicago. And for the last 12 years, I've been exposed to the online, what they call retail, which I hate that term, the online independent trader world. And I've learned a lot about what goes wrong because I've talked to so many traders, and we do these group mentoring sessions and stuff at Convergent, and we get to see what everybody's struggling with. And I would say this to you: don't just trust what somebody's saying. Don't trust what I'm saying. Don't believe me. Verify it for yourself. Observe. Replay charts. One of the best features of Bookmap is the replay feature. Record your live sessions and replay them. And by replaying and replaying, you get to see some stuff that just repeats and repeats. And your job is to sit down, quantify that edge, figure out, okay, in order for me to exploit this piece of information, how much do I need to risk? At the end of the day, your stop is nothing more than the cost of a ticket. It's like a lotto ticket, but it's not gambling, because gambling implies a low probability of winning. It's not gambling. It's wagering. It's taking an educated guess using your money. It's an investment. It's like starting a business doesn't guarantee you'll make money. Trading is the same. Your stop is the price of the ticket. The price of the ticket in order to see whether you're right or wrong. So your goal is to quantify what you're doing, combine that with really stringent risk management. You cannot let your emotions get in the way. This is why it's important to understand, and the reason I went through this lengthy process of putting Bookmap's usefulness in its place in my book, right? If you pull up Bookmap on its own, this is a formidable tool. I wish I had this when I was a prop shop owner. I would think that I would have doubled the returns on my traders with this easily. That's just my opinion, because there's so much we used to memorize that you don't need to anymore. We can see, we can examine, we can zoom in. Wish I had this, okay? But if you go and use this on its own and sit here and just beep, bop, beep, bop, beep, bounce in and out of trades, it's really hard to sustain that as an edge. So understand that you need to find some that the market has these repeating patterns, because it's a living thing. It's like it's the cumulative consciousness of all the participants in it, the traders in it. So humans have a certain way of thinking, and it's reflected in the market. It's not all automated like people tell you to. Yes, the volume is automated because it's executed by computers, but the decisions are made by humans, which result in computers making decisions based on that. But take that, find something that kind of repeats itself. I discussed one or two things here, and then apply some really stringent risk control. Because your job as a trader is to be here tomorrow. That's it. My job is to pay up to see the next card, like on a poker table. Try to pay up as little as possible to see the next card, but keeping an eye on the fact that I can't pay too much because I need to come back tomorrow and do this again and again and again. It's unfortunate over the last 12 years, I've seen people make a huge effort and then go out in a blaze of glory, just go out blowing up completely when I felt that they were so close. They've invested a lot of time and they just get tired of it, and they just like take a bad trade and then they're like, screw it. I only have $1,000 left in my account. I'm just going to triple down on the micros and just let it ride. It's unfortunate, because as soon as you give up that risk control, you're going to wash away. So pay attention to that. You need an edge. You need some risk control, and understand that losses are a part of this. Losses are welcome. I'd rather take $1,000 loss on a trade than to be stubborn or attached and risk $50,000 on a trade, and then I can't trade tomorrow. And use this tool to be able to pinpoint or snipe the locations where you want to trade. You want the order flow to be on your side. This simplifies the ability to read order flow. So that's it. I know that you can just, I think in order to see, the Bookmap deal, I think that maybe is no longer valid, but to get information on what I'm doing or to ask questions, you can just go to convergenttrading.com /contact. I'll do my best to help out, but that's the place to find me. Okay, I'll leave you with those words. Sorry, Bruce, we went way over, but I hope I've impacted everybody here positively in some way. That's really the effort I've been making for the last 12 years for the online trader. I just want to impact your trading in some positive way. It's good for the industry. Take care, everyone, and thanks for having me on, Bruce.
Thank you, FT.